Moving Average Convergence Divergence, or MACD, is one of the more popular momentum indicators used by technical analysts. It's a trend indicator which is made up of an oscillator component combined with a moving average component. The MACD is calculated as the 12-period exponential moving average minus the 26-period moving average. The second component is called the signal line, which is a 9-period moving average of the MACD line itself. The MACD is positive if the 12-period MA is greater than the 26-period MA. It's negative if the 12-period MA is less than the 26-period MA. If the 12 and 26 periods are the same, the MACD will be 0. Let's talk about two types of signals. The first one is called a bullish or bearish MACD crossover. A buy signal is when the MACD line crosses above its signal line. A sell signal is when the MACD line crosses below its signal line. And the second signal is called a centerline crossover. A bullish centerline crossover is where the MACD crosses above 0, and a bearish centerline crossover is where the MACD crosses below 0. The MACD is also used to spot divergence with the price. This is where higher highs for the price are not confirmed by higher highs with the MACD, or lower lows for the price are not confirmed by lower lows from the MACD. Let's take a look at a real-world example now. Here is the chart of the US 500 or the S&P 500. Now we can see that we got a sell signal here where the MACD line crossed below its signal line, and we got a buy signal here where the MACD crossed above its signal line. And here is a bullish centerline crossover where the MACD crossed from below to above 0.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.